Guys, these are 5 stocks that are reporting earnings this week. Let's analyze them to see if they're potential stocks to buy. Stock number 1, Nflx. Guys, Nflix has the rebound of rebounds. Look at this. All-time high, November 17th, 2021 of $700. Look how low it got. This is sub 200. This is like 160, 130. I don't remember the exact low, but it's just been on a march since then. Incredible. $286 billion market cap. $7 billion in free cash flow last year compared to the 5-year average of 1.96. Now, in past videos, my biggest concern about Nflix was their discrepancy between free cash flow and earnings. Now, if you're new to the channel, I like to see free cash flow higher than earnings. In the past, it was always earning significantly higher than free cash flow. Now, I did say they do invest a lot of money in the business, but it's always a concern of mine. However, now look at this. The 1-year free cash flow, $6.95 billion. The 1-year net income, $6.44. To show what I was saying before, though, the last 5 years of free cash flow, about $2 billion. The last 5 years of net income, $4.5. So, has this changed finally for the company? That's going to be really important for investors out there to understand. All right, $306 billion enterprise value versus $286 billion market cap. This $20 billion difference is debt. And if they can keep this free cash flow of $7 billion and growing, this is a great balance sheet. So, has Nflix turned the page on its discrepancy of its free cash flow and earnings? That's really, really important to me and something that I want you to understand, whether it's about Nflix or any other company out there. Now, another thing I like, increasing free return on invested capital. It's at 13% in the last year. So it's above average, which is great, and hopefully increasing. Now, the story, the 2 X's here on 5-year earnings and 5-year free cash flow, which we talked about. We're sitting here looking at these big discrepancies here, but hopefully that's the end of that. We'll see. Shares outstanding, they bought back a few shares. Guys, this is 41 times free cash flow, 44 times earnings. Again, if it's a high moat business with a lot of growth potential, that can justify a higher multiple. The question is how much higher? And we talked about before, the debt level, if they can keep this free cash flow going, this number will plummet. So not terrible to look at, not bad. Now guys, here are the analyst estimates. Look at this growth. 1881 this year for earnings per share, growing to 3560. Doubling in the next 4 years. That's what I mean, almost doubling. That's what I mean about growth. Major growth companies deserve a higher multiple. The question is how much? What about revenue growth? 40 billion to 58 billion. So not as much, but good growth. Now, guys, there's no doubt in my mind that Nflix is the number 1 streamer, in my opinion. But there's a lot of competition out there. But I think the competition's starting to decline in the sense of I think there's going to be more consolidation in the business. Nflix has done a great job cementing itself as this leader on streaming. It is the first app I go to when I want to stream. And I'm sure a lot of people feel the same way. So just remember that in terms of its hold on the market. All right. Now, what is the company worth to us? When was the last time I did Nflix? Nflx, April 17th. Okay. I did a 10-year analysis. I did 5, 8, and 11% revenue growth. Guys, I'm going to change that a little bit. I'm going to go with 4, 7, and 10. Profit margin. I did 13, 16, and 19%, which I think is appropriate. And I equated the free cash flow the same thing. Because even though they haven't done this in the last 10 years, it's still a growing business and they're getting more and more stable. So I think you got to give them a little bit more benefit on the middle range for profit margin and free cash flow margin. Just my way of thinking. Again, how you apply it to your investments is really important on what makes sense to you. This is what makes sense to me. Now for PE, I did 17, 20, and 23. Same with the free cash flow. And for my desired return, 9%, because the market's going to do 9 or 10%. So this is going to give me what I think the intrinsic value is for the company. This does not include margin of safety. So on this company and any company you do, I recommend a margin of safety because if you're not going to put that in, why not just buy a long-term ETF and match the market and not think about it? So I hit the analyze button and my prices are a low price, 183, high price of 520, middle price of 315. So based on 662, to me, it just seems a little expensive. As an example, let's go to an extreme and say that revenue growth is going to be, well, actually, if you just look at it here, 10% revenue growth still has a hard time justifying this. Even if they hit the highest numbers here, you're only going to make about a 6% return based on the current price purchase. Now, anything can happen. We've seen the stock fall many times, so there will be probably an opportunity to buy it at a lower price in the future. What I'm trying to teach here is that process to be patient along the way. Stock number 2, Johnson & Johnson at $149 a share. All-time high was $186 on April 25th of 2022. So it's been over 2 years since it's seen its all-time high. One of the attractive things for a lot of people out there is a dividend yield of 3.2%. Now, there's a discrepancy between net income and free cash flow, 18 to 38 billion, even though the 5-year number is 19 versus 20.7. So it tells me there was probably some 1-year gain they had that did not affect cash flow. So I'm not as concerned about this. But this 3.2% dividend eats up $12 billion of their free cash flow, over 60% of their free cash flow. That's a lot. But the question is, does this company have a lot of growth potential? Well, I don't know, but I do like the fact that they have a pretty solid return on invested capital. And if they have no ways of reinvesting their money, maybe that is a good place to put it by paying a dividend. Their PE is 20. Their PE is 9 because this 1-year fluke, and their price to free cash flow is 20. So it's not screamingly low where I'm going, go buy back your shares. Because remember, it is better for them to buy back shares if there's cheap enough where it adds a lot of value. What's that number? Also depends on what the company is like. For one company, a multiple of 15 might be cheap enough. Another company might need 7 or 8 multiple to buy back shares. It just all depends on where we're at. So here's the story. Well, we've got only 1x, and that's cash flow falling $1.5 billion. Revenue growth, $7 billion. So they're still having some growth here. Very reasonable debt, 2.8 times the last 5 years free cash flow. Buying back some shares. Okay, good ROIC. Like everything here, nothing here is telling me that I need to avoid this, and nothing is telling me that, oh, wait, what is going on here? Except for this $21 billion increase in net income. So let's go check that out before we go further. The net income in the last year. Okay, $35 billion. Now look at the history. 16.3, 15.5, 16.5, 1.3, obviously a fluke. 15.3, 15, 14.7, 21, 18.35. Okay, so let's see above in the lines where we can see some sort of big gain. Wow, that's interesting. The line right above, income from discontinued operations, $21.83 billion. Take that away, and you're at $14 billion. But you also had an other income expense of negative 8.8. So they probably still had a pretty darn good year, even factoring that in. But don't make your decision based on the current PE and that current 12-month net income. That's the reason why I'm teaching you as part of this process to dig deeper. You don't have to dig much deeper. You don't have to sit there and know what the lunch is of all the C-suite executives. All you need to be able to do is sit there and say, why is this out of check? That's why the 8 pillars are so important in terms of telling you a story to go in there and to look further. So let's see what analysts are saying about the company. EPS growth, not a lot. Look at this, 7%, 2.8, 5, 1 point. It's a slow grower. Slow. That's fine. If you can get a company cheap enough that's growing slow, you can still make a great return on your money. Remember, you make your money on how you purchase it, not on what it does. Yes, what it does is important, but that's going to happen no matter if you pay $100 for the stock or $500 for the stock. The future is going to happen no matter what. So the less you can pay, the better. Now, that doesn't mean go to try to time the market on buying at the low. That's not going to happen. That never happens. What's key here is to sit there and buy it at an appropriate price. And then if it falls further, continue to buy as long as your thesis is the same. What about revenue growth? Very little. 4, 2.8, 3, I mean, basically inflation. Okay, makes about sense. Okay, so let's go put the stock analyzer tool in here. Remember, guys, with a big dividend, our returns that it explains is including the dividend yield. It's not on top of the dividend yield. So my assumptions, remember, guys, on all these stock analyzers does not include the balance sheet. I did 2, 3, and 4% revenue growth. Okay. I did 19, 22, and 24% profit margin. Remember, This is obviously, these are all driven up by the last year, which was huge. So I still did 19, 22, and 24. Same with free cash flow because of their last 10 years of free cash flow. 16, 19, and 22 on my earnings multiple, as well as my free cash flow multiple, and our 9% return, market return. Our intrinsic values are as follows. A low side of 100, high side of 185, middle price of 140. I have it on my watch list at 140, but not to buy it there. For me, it's a, Paul, go reassess and sell puts at a lower price in order to buy the company cheaper. Stock number 3, Taiwan Semiconductor, TSM. It's currently at $187 per share. Look at this run-up it's had recently. Big time run-up. All-time high was just a few days ago at 193. All right, so it's on its all-time highs, which is okay. If a company's really killing it, don't be afraid to pay as long as the metrics and the financials make sense. Don't be afraid of an all-time high, okay? We got a really good return on invested capital, 14.3 last year, 16% in the last 5 years. Now, here's the issue I have. They have a $970 billion market cap, $976 billion enterprise value. So great balance sheet. Only $5 billion here of essential net debt. But look at this dividend, $9 billion. In the last 5 years, they've averaged $10.5 billion in free cash flow. They're eating up 90% of their last 5 years free cash flow. With that said, this last year, they had $14 billion in free cash flow. Now, another thing I don't like, look at their net income, $27 billion in 1 year, $21 billion in the 5-year average. Very different than their free cash flow numbers. You've got to understand why. That's a big thing in our community. If you're in our community and you love this stock, you need to go determine why that difference exists. Have that conversation. Dalton's in there. He's great at research. I'm sure he's done this before. Go reach out to him. He's a great resource for that, okay? So, 8 pillars. Let's go see what the story is on the 8 pillars. All right. Like a lot of companies, we've got the 5-year PE, 5-year price of free cash flow. As you can tell, free cash flow overall is lower. That's why the ratio is higher. This is kind of an issue. Okay, fine. $33 billion in revenue growth. I mean, there's a lot of great stuff here, guys. This company feels, based on the story, I mean, look at this. 0 change in shares outstanding, which I'm glad. It tends to be a thing that's done in Asia and Europe. They don't buy back a lot of shares, but I'm glad that they're not buying back shares that are expensive. Okay, so my biggest issue is, why is there such a difference between free cash flow and earnings? So let's go to analyst estimates. Not as much growth as I would have thought. $1.22 in earnings this year to $1.95. Oh boy, big difference. That's not good, but some growth there. And revenue growing pretty steadily from 85 billion to 126. So guys, the stock analyzer tool here, even though, I mean, the issue is for me personally, I like to focus on free cash flow. But as you remember, on the Nflx example, when I focused on free cash flow, I was waiting for, and then it happened suddenly for free cash flow to catch up to earnings. Is this a permanent fix for Nflx? I hope so. Taiwan Semiconductor, what's going on there? Guys, I did a really wide range on Taiwan Semiconductor. This is probably one that's out of my circle of competence and probably one for me that's in the too hard pile, so I'd probably just move on. But just for you guys, the users, I want you guys to see this. I did 1, 7, and 13% revenue growth for the next 10 years. It's a wide range. 35, 38, and 41 profit margin, 17.5, 20, and 22.5 for free cash flow, 16, 18, and 20 on my earnings multiples, and we're going to put our 9% in across the board. Hit the analyze button. A low price of 32 on free cash flow, high price of 118, middle price of 60. For me, it's just, I'm just excluding it from my whole entire look. This is what makes investing difficult, but also what makes investing beautiful. You need to find the thing that works for you, okay? And as I talked about before, for the community, if you're in the community, have the conversation in here. If you're not in the community yet, you probably have noticed, I don't know if you have, that we do have limited daily spots for our software and community. And the reason for that is the software as it exists today includes everything we have to offer for stocks, retirement, and real estate. All of these tools right here, okay? But behind the scenes, we're making a lot of changes. So in the near future, that current offer is going to go away forever. We've been engaging with our users, getting feedback from the community members, and they've expressed they want to focus on specific aspects of the Everything Money tools that apply to them at that moment in time. They don't want to have too many options like the Cheesecake Factory, and we don't want to be the Cheesecake Factory of software. If you've been watching our channel for a while, from the beginning even, you'll remember I built this software for myself and my team selfishly so that I could use it to constantly make better decisions for stocks, real estate, and retirement. But as people made the request, we made the software for the users, and we've grown our channel and our community so it becomes less about me and more about how I can better serve you and the community members. The good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life with all of these tools. You'll get all of these. And this is the best deal we're ever going to offer. There's still time, and I'm telling you this now for that reason. There's still time to sign up. So click in the link in the description below. Sign up. Join the community today before we make these changes. That way you can keep all these tools. Because once we've made the changes, you'll only get limited number of tools and have to pay extra for the other ones. Stock number 4, American Express. Now, this is a company I own. And as I always tell people, don't buy a company for any reason because somebody else has bought it, even Warren Buffett. So American Express is at $240 a share. Poop on that. All-time high, May 20th of 2024. It's about $1 from its all-time high of $243. All right. Now, American Express is also a company that Warren Buffett owns. But again, we don't buy things because this Warren Buffett does it. Look at this, guys. Free cash from last year, $23 billion. Net income, $9 billion. 5-year average free cash flow, $12.5 billion. Net income, $7 billion. So their multiples are very, very low. Now, immediately makes me think, okay, am I missing something here? Because American Express isn't some small company. Should I be looking at it like I look at a business that does transactions? Now, they do some loans, things like that, and that does change the dynamic a little bit. But is this more of a bank or more of like a Visa, MasterCard? I think it's more of a Visa, MasterCard. So I continue on with this. Now, they do have a dividend of 1%, but it's so negligible. Eats up less than $2 billion of their $12.5 billion in the last 5 years free cash flow. So a lot of potential here. I think that dividend's very safe. But look at this market cap, 175 versus enterprise value, 408. That's what makes me think bankish, that they have a lot of outstanding liabilities. But again, it's not like a bank in the typical sense. So it's kind of one that I really feel like you like to understand what you're doing here. Again, talk to Dalton in the community. He's great at understanding these things. So let's go take a look at the analyst estimates. I'm not even going to look at the 8 pillars because of how skewed those numbers are. But not a lot of growth here on earnings on EPS. 13 to 16.50. I mean, it's growth, but it's not huge. And revenue, decent. Nothing huge though. Not a ton. 67 billion to 88 billion in the next 4 years. All right. So, but I would ask you, do you think American Express is going anywhere? I have a hard time believing they're going anywhere. Could it change? Of course it could change, but it's American Express. There's a lot going on at American Express. They are the exclusive credit card company. Now, I'm not going to do a stock analyzer on American Express because I think this is more of a understanding why you own American Express and understanding the balance sheet involved. So I really encourage you, if you're in our community, have a conversation about it. If you're not in our community, it's worth the awesome trial we have in the description below to be able to talk about just American Express. Now, stock number 5, ASML. I want to read the description for you. This is a quote-unquote expensive stock with $1,000 per share price. Remember, $1,000 per share doesn't mean anything. It could become $100 per share if they have a 10-for-1 stock split. It could be $10,000 per share with a reverse stock split. But I want to read to you how confusing this description is. Now, ASML is the leader in photolithography systems used in the manufacturing of semiconductors. Photolithography is the process in which a light source is used to expose circuit patterns from a photo mask onto a semiconductor wafer. Blah, blah, blah. I have no idea what that means. No clue what that means. If anybody here has an idea, you're probably an electrical engineer. Write it below in a way that a high school freshman could understand, right? That's really important, okay? So I'm going to look at the numbers here. If the numbers make sense, I definitely want to understand what they do and why it's going to be around for a long time. because that's my thesis. I want to buy companies that I think are going to be around for a very, very long time. Now, balance sheet. $428 billion market cap versus $448 enterprise value. That $21 billion difference is essentially their net debt. They have a 5-year average free cash flow of 5.7, 1-year free cash flow of 2.6. So big question to ask. Why is there a drop? Does that have to do with the chip shortage we had a few years ago that really drove up their free cash flow? So I'm immediately going to go to the free cash flow statement and analyze the last few years. So free cash flow in the last few years. 2.6, 4, 10.8, 7.8, 3.5. Looks like these 2 years were the fluke that happened because of the chip shortage. Look at it previously. 720, 18, 15, 16, 27, 36, 26, 4 billion. So I'm looking at going, it's probably more along the lines of what they've done in the last 12 months as they're probably ongoing normal level. Remember, you don't want to overpay because they're having a fluke year because of some limited demand that occurred, some limited demand event that occurred. Just like Southwest Airlines and all these other airlines went to pretty much zero revenue for a year during COVID. Does that really value the company accurately? No. So the same thing occurs when there's a fluke jump in revenue and profit. So just remember that going forward. So what are the 8 pillars telling us? Well, what we've talked about here. Now, the thing I want you guys to remember is the current free cash flow multiple is 165. The current 5-year free cash flow is 75. Current PE is 55. Current 5-year PE is 75. This screams expensive. Even with a really good return on invested capital, 22% for the last 5 years, 28% last year, overpaying for a good thing is still overpaying. Should you pay more for a good thing? Absolutely. But should you overpay for a good thing? No. There is a difference between paying more and overpaying. You can pay more for a Ferrari versus a Ford, but you can underpay for a Ferrari even though it's paying more than a Ford, and you can overpay for a Ferrari even though it's a phenomenal thing. I want you to repeat that over and over. That's very, very important. There's a difference between paying more and overpaying. Very big difference. I want you to avoid overpaying. The issue with investing is it's an art. We don't know the future. We don't know what overpaying really is until the future happens. That's why we have margin of safety. So let's go check out analyst estimates. Good growth here, guys, in EPS. 60%, 13.5, 21.5, 13. Growing from $21 a share this year to $52 per share. It's a lot of growth. Again, it's analyst expectations. What about revenue growth? Big time revenue growth. 31 billion to 56 billion. A lot of growth there. Another reason to pay a premium. So let's go look at our stock analyzer tool. I haven't done this in a long time. And I'm going to do my 9% return across the board. I did 6, 9, and 12% revenue growth for the next 10 years. I did 22, 23.5, and 25% profit margin, 24, 27, and 30 on free cash flow. Now remember, the last few years have been skewed because of 2 of those years. So make sure that you don't base your assumptions based on the highest numbers here in this situation. But a company like Disney or Southwest, I personally believe their recent 5-year profit margin and free cash flow margin are way lower than they will be in the long run. So that's what's the story that you have to understand. That's part of the story you need to understand. PE. Guys, I'm going to do a different PE here. It's a high return on invested capital business. So I'm going to start at 15. I'm going to do 18 and 21. So I'm going higher than I did before. That return on invested capital is very high. That tells me this is a company that has a moat, has moat status, and gets a good return on the money invested in the business, and they have growth potential. I want to give them a premium. How much premium? I think this is reasonable. If I understand more about the company and think there's better reasons for higher, I would do so, and vice versa. So I hit the analyze button. Guys, I got a low price of 300 to 333, high price of 700 to 800, middle price of 460 to 500, which should not be a shock based on the current PE. Guys, thank you very much for your time. Go watch our next video on our 52-week lows. It's a great place to start looking for value. Take care.